Imagine taking your retirement money, your IRA funds, and actually buying like a physical property with it, maybe a rental house, maybe some land. It feels like this incredibly powerful move, right? Building wealth outside of just stocks and bonds.
It definitely appeals to a lot of people, that tangible asset idea.
But here's the thing we found digging into the sources, the real catch. Yes, you can do this with something called a self-directed IRA, an SDIRA.
Right.
But it's absolutely not a free-for-all. It's like this opportunity comes wrapped in a super strict set of rules, mostly from the IRS.
And getting those rules wrong is, well, it's bad news. Serious penalties.
Exactly. It could completely derail your retirement plan.
Yeah.
So that's our mission today, right? We're doing a deep dive into these sources, IRS documents, expert insights from custodians like Entrust.
Yep.
We want to pull out the absolute must-know stuff, focus really hard on the rules you have to follow and the big risks involved when you use an SDIRA for real estate. We want you to walk away really understanding the key things.
And just to level set quickly, what is a self-directed IRA? It's not like a totally separate type of IRA, like traditional versus Roth.
Right.
Think of it more like a standard traditional or Roth IRA, but it's held somewhere with a custodian that lets you invest in a much broader range of things.
Okay.
Instead of just the usual stocks, bonds, mutual funds you get at a typical brokerage.
Yeah.
An SDIRA opens the door to alternatives. And the sources definitely show real estate is probably one of the most popular alternatives people look at.
Gotcha. So same IRA structure, bigger menu. Why is real estate such a popular item on that menu based on what you saw?
Well, the sources point to a couple of main reasons. Diversification is a big one. People want to spread their risk beyond just the stock market, you know?
That makes sense.
And real estate feels tangible. It's something people often feel they understand better than, say, complex derivatives. They might feel like they have more control.
Physical asset.
Exactly. Plus, there's the potential draw of rental income, property appreciation, and having all that potentially grow tax-deferred or tax-free inside the IRA. That's a pretty powerful combination for boosting retirement savings.
Yeah, I can see the appeal. Owning a building feels different than owning shares on a screen.
Yeah.
But that bigger menu, that self-directed part, that comes with a pretty big responsibility, doesn't it?
Oh, absolutely. The sources are crystal clear on this. With an SDIRA, the job of checking out the investment, the due diligence, falls almost entirely on you, the investor.
Not the custodian.
Nope. With a regular IRA, the brokerage usually offers a curated list of investments. With an SDIRA, you're the one finding the property, figuring out if it's a good deal, checking the market, understanding all the risks. You make the call.
And the custodian just holds the asset.
Pretty much. Their role is mainly administrative. They hold the title. They process transactions you direct them to make. They handle the IRS reporting. But they don't approve the investment itself. They won't tell you if that rental property is a lemon. That's all on you.
Wow. Okay. So that due diligence burden is huge. And that leads us right into the absolute core issue. The sources hammer home the rule book.
Yes.
The IRS has these strict rules to protect the tax benefits of the IRA. And if you break them, you trigger these things called prohibited transactions.
That's the danger zone, and the consequences are severe. We're talking potentially disqualifying the entire IRA going back to the beginning.
Yikes. Okay, so what are these prohibited transactions?
It's really the foundation you have to understand. These rules are all about preventing the IRA owner, or people close to them, from benefiting improperly from the IRA's assets before retirement.
Keeping it separate from your personal finances.
Exactly. Keep the retirement money firewalled off from your personal life and business dealings until you actually take a proper distribution.
So let's nail down the big ones, especially for real estate. What are the absolute must-know prohibited transactions?
Okay, number one, according to the sources, is self-dealing. Big category. This stops transactions between the IRA and certain people called disqualified persons. That includes you, the IRA owner.
So the IRA can't buy my personal property?
Correct. It can't buy a property from you or from a business you control. It also can't sell property to you. You can't borrow money from the IRA. Basically, your IRA can't do business directly with you or your close family.
Got it. Clean separation. No using the IRA to bail yourself out or buy something you already own.
Precisely. And tied right into that, and maybe the most common trap for SDIRA real estate folks, is the rule against personal use.
Okay.
This one is super clear, and the IRS enforces it strictly. The IRA owner or any disqualified person cannot live in, vacation at, or use the IRA-owned property in any personal way.
At all.
At all. You can't use it for your business either if you're disqualified. And this isn't just about now. It applies to the future, too. You can't buy your dream retirement home with your SDIRA today, rent it out for 10 years, and then plan to move in.
So just moving in later would blow up the whole thing.
That would trigger a prohibited transaction, yes. The moment personal use occurs, potentially.
Wow, so even if I own a rental property through the SDIRA, I can't even crash there for a weekend while I'm checking on it.
That's generally the very strict interpretation, yes. Any personal benefit, any personal access by you or other disqualified persons is a huge red flag. It has to be purely an investment for the IRA's benefit.
Okay, purely investment. What else?
Another critical one, especially for handy folks, is the rule against the IRA owner or a disqualified person personally performing services or repairs on the property.
Wait, seriously. So let's say I own a rental in my SDIRA. The tenant calls, says the toilet's broken. I'm a licensed plumber. I can't just go fix it myself.
That's correct. And I know it sounds completely counterintuitive, right? Especially if you're used to being a hands-on landlord.
Yeah, why pay someone else when I can do it?
Because the IRS views you providing that service as a form of self-dealing. You, a disqualified person, are contributing value, your labor, to the IRA asset outside of a normal contribution. So all repairs, maintenance, improvements, everything has to be done by unrelated third-party professionals, and they have to be paid market rates directly out of the SDIRA's funds. Your sweat equity is not allowed.
Man, that adds costs and hassle.
Mm-hmm.
Good to know, though. Any other big prohibited transactions the IRS mentions?
Yeah, the source lists a few more general ones. You can't use IRA assets, like the property, as collateral or security for a personal loan.
Okay.
And just reinforcing the point, buying property specifically for personal use with IRA funds is prohibited right from the get-go. These rules all circle back to the same idea. The IRA is for retirement savings. It's tax advantage for that purpose. It's not a personal slush fund or a way to get personal benefits before retirement.
This term disqualified persons keeps popping up. You mentioned it includes the owner, but who else falls into that category according to the IRS? It sounds like it's broader.
It is definitely broader, and you absolutely need to know who's on this list. So besides the IRA owner themselves, it includes their spouse, it includes their ancestors, so parents, grandparents, and their lineal descendants, children, grandchildren, great-grandchildren.
Wow.
And importantly, the spouses of those lineal descendants are also disqualified persons.
So my son-in-law or daughter-in-law, too.
Correct. Your direct family line up and down, plus their spouses. That's a pretty wide net you need to be aware of when dealing with IRA assets.
Definitely. Anyone else?
Yes. The definition also includes anyone providing services to the plan, like a fiduciary.
What's a fiduciary in this context?
It's someone who manages the IRA or its assets, gives investment advice about the IRA for a fee, or has administrative responsibility for the IRA. So your SDIRA custodian, the company holding the account, they are typically a fiduciary and therefore a disqualified person.
So I can't have my IRA buy a property from my custodian's separate business or something like that?
Generally, no. Transactions between the IRA and any of these disqualified persons or entities controlled by them are prohibited, unless there's a very specific, rare exception allowed by law. The simple rule of thumb. Keep the IRA's dealings completely separate from your personal financial world and that of your close family and service providers.
Got it. Keep it clean. Are there any other things an SDIRA just flat out can't invest in, besides these prohibited transaction triggers?
Yes. Even with the expanded options, there are still limits. The IRS source specifically says IRA funds cannot be used to buy a life insurance policy.
Okay, no life insurance.
And while our specific sources didn't go deep here, it's generally known that certain collectibles, things like artwork, antiques, gems, most coins, stamps, alcoholic beverages, are also prohibited investments. There are some exceptions for specific types of bullion or coins, but generally collectibles are out.
But real estate is explicitly okay.
Real estate is explicitly allowed, yes, as long as you navigate all this prohibited transaction rules we just discussed.
Okay, so let's say you navigate the rules. The SDIRA buys the property. How does the day-to-day money stuff work? Like rent checks coming in, paying property taxes?
This is another area where you have to be super careful, meticulous, really. All the income the property generates, every penny of rent, any proceeds if you sell it later, has to go directly into the SDIRA account.
Not my personal bank account first, even for a day.
Absolutely not. It can't even touch your personal account. The Entrust source had a great practical example. The rent check shouldn't even be payable to you. It should be payable to the custodian for the benefit of your IRA.
So like payable to SDIRA Custodian Inc., FBO My Name IRA.
Exactly like that. FBO for benefit of. It makes it completely clear that money belongs to the IRA from the start.
Okay. And expenses, paying the property tax bill or that plumber we had to hire.
Same principle, just in reverse. All expenses related to the property taxes, insurance, HOA fees, repair costs from that third-party contractor must be paid from the funds held inside that specific SDIRA.
Can't just write a personal check and reimburse myself later.
No, definitely not. Paying an IRA expense with personal funds could be seen as you, a disqualified person, adding assets to the IRA outside the legal contribution or rollover channels. That could be a prohibited transaction or maybe an excess contribution. Big problems either way.
Man, this really drives home the point. The SDIRA is like a totally separate financial bubble for this property. All money in, all money out, stays inside the bubble.
That's a perfect way to think about it, a distinct silo.
Yeah.
And linked to that money flow is making sure the property ownership is correct legally. The sources really stress property titling.
How does that need to look?
The deed, the official title to the property, must be in the name of the SDIRA custodian for the benefit of your IRA. It absolutely cannot be in your personal name or even jointly held between you and the IRA.
So again, something like SDIRA Custodian Inc., FBO My Name Traditional IRA.
Precisely. That formally records that the IRA, not you personally, owns the asset. It protects the tax status.
Okay, this gives a really clear picture of the rules once the property is in the SDIRA. But how do you get the money into the SDIRA to buy the property in the first place? What are the funding options?
Right, good question. The ways to fund an SDIRA are generally the same as for any IRA. First, you have annual contributions.
The standard IRA limits.
Exactly. For 2024, the limit is generally $7,000 if you're under 50. If you're 50 or older, there's a $5,000 catch-up, so you can contribute up to $8,000.
And that's total across all my IRAs.
Right.
Like if I have a traditional and a Roth.
Yes, that limit covers your total contributions combined across all your traditional and Roth IRAs for the year.
And I need earned income to contribute. Yeah. What the IRS calls compensation.
Yes, that's fundamental. You must have taxable compensation of at least the amount you contribute. You can't fund an IRA just from investment gains or passive income.
What counts as compensation? Is it just salary?
The IRS source gets pretty specific here. It's mainly income from working, so wages, salaries, commissions, tips, that kind of thing. If you're self-employed, it's your net earnings from your business, but you have to subtract deductions for contributions to your own retirement plans, like a SEP or solo 401k, and also subtract half of your self-employment tax.
That makes sense. Anything else?
It also includes taxable alimony or separate maintenance, but only if the divorce agreement was from 2018 or earlier and hasn't been changed to exclude it. Also, non-taxable combat pay counts and certain taxable graduate or postdoc fellowship stipend payments for tax years after 2019.
What about things like rental income or dividends? Do they count?
No, and the IRS is explicit about this. Compensation does not include earnings from property, like rent. It doesn't include interest or dividend income. It doesn't include pension or annuity income or deferred comp. Basically, passive income or investment returns don't count as compensation for IRA contribution purposes.
That's a critical distinction.
Mm-hmm.
Okay, so contributions are one way in, but often not enough for a real estate down payment. Rollovers are probably more common for SDIRAs.
Absolutely. Moving money from other retirement accounts via rollovers is often how people get the significant funds needed for real estate into an SDIRA.
Where can the money come from? Old 401k.
Yep. You can roll over funds from a former employer's plan, like a 401k, 403b, governmental 457, or profit-sharing plan. You can also roll over funds from another existing IRA into your SDIRA.
How does the rollover process work? Are there different ways?
There are basically two main methods the IRS outlines. The first is what's called an indirect rollover, or sometimes a 60-day rollover.
Okay.
With this method, the money from your old plan or IRA is paid directly to you. Then you personally have 60 days from the day you receive the funds to deposit them into your new SDIRA.
60 days seems tight. Is there a catch?
There's a big one, especially if the money comes from an employer plan like a 401k. If the plan pays the distribution directly to you, they're generally required to withhold 20% for federal income tax.
Whoa, 20% off the top.
Yeah, so you'd only receive 80% of your account balance. Now, if you want to roll over the full original amount to avoid taxes and penalties on the 20% portion, you have to come up with that missing 20% from your own funds when you make the deposit into the SDIRA within the 60 days.
That sounds risky. And requires having extra cash lying around.
It does. You might get the 20% withholding back when you file your taxes, but it's a hassle up front. That's why the second method is usually much better.
What's that?
It's the direct trustee-to-trustee rollover, sometimes just called a direct rollover. Here, you tell the administrator of your old plan or IRA to send the money directly to the custodian of your new SDIRA.
So the money never touches my hands.
Exactly. It goes straight from institution to institution. And the huge advantage, especially coming from an employer plan, is that there's generally no mandatory 20% tax withholding on a direct rollover.
Ah, okay. That seems much cleaner and safer. Definitely the way to go if possible.
Absolutely. It avoids that whole withholding issue and the 60-day deadline pressure.
You mentioned something earlier about a 1-year waiting period for rollovers. How does that apply? Can I only do one rollover a year?
Okay, that's a really important detail from the IRS rules. The rule is you can only do one indirect 60-day rollover from any of your IRAs within a 12-month period. So if you take money out of IRA A and put it into IRA B within 60 days, you can't do another 60-day rollover involving any of your IRAs for another 12 months.
Just one 60-day IRA to IRA rollover per year.
Per 12-month period, yes. However, this 1-year limit does not apply to direct trustee-to-trustee transfers between IRAs. You can do as many of those as you want.
Okay, direct transfers are unlimited. What about rollovers from a 401k?
Also crucial. The 1-year limit does not apply to rollovers from an employer plan, like a 401k, into an IRA. You can roll over funds from multiple different former employer plans into your SDIRA within the same year. That 1-year rule is specific to IRA indirect rollovers.
That's a huge relief for someone consolidating old job accounts.
Yeah.
Okay, so direct rollovers avoid withholding, and the 1-year limit doesn't apply coming from a 401k. Good. Anything else on rollovers? Like if you had a loan?
Yes. Plan loan offsets. If you had a loan from your 401k and then left your job, the outstanding loan balance is often offset against your account balance, basically treated as a distribution.
Can you roll that over?
Sometimes. If it's what the IRS calls a qualified plan loan offset, usually tied to termination of employment or the plan itself terminating, you actually get more time to roll it over. You generally have until the due date, including extensions, of your tax return for the year the offset happened. For other non-qualified loan offsets, the normal 60-day rule applies if you want to roll over that amount by coming up with the cash yourself. It's complicated, timing is key.
Definitely sounds like something to get advice on.
Okay.
That's a ton on just getting money in. Now, the tax rules around contributions themselves, that seems really complex in the sources, especially traditional versus Roth and income limits. Let's start with traditional IRAs. How does the deduction work?
Right. This is where IRS Publication 590A gets really detailed. We know the contribution limit, $7K or $8K is a 50-plus hour for 2024. But whether you can actually deduct that traditional IRA contribution on your taxes depends mainly on two things. Your income specifically, your modified adjusted gross income, or MEI, and whether you or your spouse, if married filing jointly, are covered by a retirement plan at work.
Okay, first, how do I know if I'm covered by an employer plan? Is it just if I have a 401k?
Usually your W-2 form will have a retirement plan box checked in box 13 if you are, but the IRS has specific definitions. For a defined contribution plan like a 401k, 403b, profit sharing, you're generally covered if any money, your contributions or employer contributions, was added or allocated to your account for the plan year that ends within your tax year.
Even if I'm not vested?
Yes, even if you're not fully vested in the employer match, for example, if funds were allocated, you're likely considered covered.
What about pensions? Defined benefit plans?
For those, you're covered if you were simply eligible to participate for the plan year ending in your tax year. Even if you chose not to join, didn't contribute if required, or didn't actually earn a benefit that year, just being eligible is enough to be considered covered.
But things like Social Security don't count. Or an old pension from a job I left years ago.
Correct. The IRS clarifies those don't make you covered for the current year's IRA deduction rules. It's about active participation or eligibility in a plan with your current employer, generally.
Okay, so let's say I am covered by a plan at work. How does that affect my traditional IRA deduction based on income?
If you're covered by a workplace plan, your ability to deduct your traditional IRA contribution starts to phase out, meaning it gets reduced as your MBGI goes up. Eventually, it can phase out completely to zero deduction.
Based on income ranges.
Exactly. And these ranges change most years with inflation adjustments and depend on your filing status. For 2024, if you're covered by a plan and you file as single or head of household, The deduction starts phasing out at $77,000 MAGI and is completely gone at $87,000 MAGI. So if your MAGI is $87,000 or more, no deduction for your traditional IRA contribution.
Okay. What about married filing jointly?
If you're married filing jointly or a qualifying surviving spouse, and neither spouse is covered by a workplace plan, the 2024 phase-out range for the deduction is $123,000 to $143,000 MAGI. Above $143,000, no deduction for the covered spouse, and it affects the non-covered spouse too, as we'll see.
The married filing separately. That always seems tricky.
Very tricky, and the limits are much lower. If you're married filing separately and lived with your spouse at any point during the year, the phase-out range is tiny. $0 to $10,000 MAGI. Basically, if your income is over $10,000, you get no deduction if you're covered by a plan.
Wow, okay. So, bottom line, having a workplace plan significantly limits your traditional IRA deduction if your income is above those thresholds. What if I'm not covered by a plan at work?
If you are not covered by a workplace plan, it's different. Generally, you can deduct your full traditional IRA contribution regardless of your income.
Oh, really?
Unless you're married, filing jointly, and your spouse is covered by a plan at their work.
Ah, there's the catch.
Right. In that specific scenario, you're not covered, but your spouse is. And you file jointly your ability to deduct your end time. Traditional IRA contribution phases out based on your joint AGI. For 2024, that phase-out is between $230,000 and $240,000. Above $240K joint MHI, even the non-covered spouse gets no deduction.
That is definitely complex. So many variables. Let's switch to Roth IRAs. Do they have income limits too?
Yes, but Roth IRA income limits work differently. They don't determine if your contribution is deductible because Roth contributions are never deducted up front. Instead, the income limits determine if you're allowed to make a contribution at all.
Regardless of whether I have a 401k?
Correct. Workplace plan coverage doesn't matter for Roth contribution eligibility, only your MAGI and filing status.
So what are the Roth income limits for 2024?
If you're married, filing jointly, or a qualifying surviving spouse, your ability to contribute directly to a Roth IRA starts to phase out at $230,000 MAGI and is completely eliminated at $240,000 MAGI. So if your joint MGI is $240,000 or more, no direct Roth contribution for you that year.
And for single filers?
For single head of household or married filing separately but didn't live with spouse, the 2024 Roth phase-out range is $146,000 to $161,000 NGI. Above 161K, no direct Roth contribution.
And married filing separately, living together, same tiny window.
Yep, same $0 to $10,000 MAGI phase out. Above $10, no Roth contribution if you live with your spouse and file separately.
Okay, so Roth is purely about income, not workplace plans. And the sources mentioned that contributing to a traditional IRA actually reduces how much you can put into a Roth.
That's right. It goes back to that overall annual limit, $7 or 8Ks. That limit applies to the combination of your traditional and Roth IRA contributions. So if you put, say, $3,000 into a traditional IRA, deductible or not, the maximum you could then contribute to a Roth IRA in the same year is $4,000 or $5,000 if 50 plus. They share the same contribution bucket.
This is clearly something you need to plan carefully. What happens if you mess up? Like contribute more than the limit or contribute to a Roth when your income was too high?
That's called an excess contribution, and the IRS really wants you to avoid it. There's a penalty.
What kind of penalty?
It's a 6% excise tax on the amount of the excess contribution. And here's the kicker. It's not a one-time penalty. You owe that 6% tax every single year, but the excess amount remains in your IRA.
Ouch. An annual 6% hit just for making a mistake. That could eat up your savings fast. How do you fix it? How do you stop that penalty?
Okay, the IRS gives you a couple of main ways. The best way, if you catch it relatively early, is to withdraw the excess contribution plus any earnings it generated.
The profit it made.
Yeah, the investment growth on that excess amount. You need to withdraw both the excess principal and its earnings before the due date of your tax return for the year you made the mistake, including any extensions you file for.
And if I do that on time?
If you pull it out by the deadline, the excess contribution amount itself isn't taxed or penalized with the 6% tax. But the earnings portion you withdraw is considered taxable income for the year you made the contribution, and those earnings might also get hit with the 10% early withdrawal penalty if you're under 59.5.
So tax and maybe penalty on the earnings, but you avoid the 6% annual excise tax on the principal? That seems like the way to go.
Definitely the cleanest way if you catch it in time.
What if I don't realize I made an excess contribution until after the tax deadline passed? Am I stuck paying 6% forever?
Not necessarily forever, but you might pay it for a year or two. If the deadline has passed, you can correct the excess by essentially using it up in a later year.
How does that work?
Let's say you put in $1,000 too much in 2023. In 2024, you're eligible to contribute the full $7,000, but you deliberately only contribute $6,000. That leaves $1,000 of unused contribution room for 2024. That $1,000 room can effectively absorb the $1,000 excess from 2023.
So you apply the old excess to the New Year's limit.
Exactly. If it was an excess traditional contribution, you might even be able to deduct that $1,000 on your 2024 tax return, assuming you meet the deduction rules for 2024. This stops the 6% penalty from applying for 2024 and future years.
But what about 2023?
You would still owe the 6% penalty for 2023 because the excess amount was in the account during that year after the correction deadline. So you fix it going forward, but you still pay for the years it sat there uncorrected.
Okay, so catch it early is best. If not, apply it later, but expect to pay the penalty for the time it was sitting there. This really highlights needing to track contributions carefully. You also mentioned the early distribution penalty earlier. Can we just quickly recap that?
Sure. It's the general rule for pretty much all IRAs. If you take money out before you reach age 59 and a half, the taxable portion of that distribution usually gets hit with an additional 10% tax on top of your regular income tax.
Designed to discourage tapping retirement funds early.
Exactly.
Yeah.
Now, there are exceptions to this 10% penalty. The IRS lists them in Publication 590B, things like certain medical expenses, higher education costs, first-time home purchases up to $10K, disability, etc. But the default is if you're under 59 and a half and don't meet an exception, you pay the extra 10%.
But you said pulling out excess contributions timely might avoid this.
Correct. That's a specific correction mechanism. If you withdraw an excess contribution plus its earnings before the tax deadline, only the earnings are subject to tax and potentially the 10% penalty. The principal portion, the excess contribution itself, comes out penalty-free in that specific correction scenario. That's different from just taking a regular early withdrawal of funds that were properly contributed.
Got it. That distinction is important. Okay, one last major rule area from the sources. Recharacterizations. What on earth is that?
Yeah, it sounds complicated. A recharacterization is basically like saying, oops, I meant to contribute to a different type of IRA. You're treating a contribution originally made to, say, a traditional IRA as if it had been made to a Roth IRA instead, or vice versa.
Why would someone do that?
A common reason might be you contributed to a traditional IRA thinking you could deduct it. Later, you do your taxes and realize your income was too high for the deduction because you were covered by a work plan.
Oh. Right.
If you still qualify to contribute to a Roth IRA based on your income, you could recharacterize that non-deductible traditional contribution into a Roth contribution for the same year.
So you can kind of switch its label after the fact.
Sort of, yes, under specific rules. You have to transfer the original contribution amount plus any money it earned or minus any loss it had from the first type of IRA directly to the second type. And you generally have to do this by the tax filing deadline for the year of the contribution, including extensions. You also have to report it properly to the IRS, usually on Form 8606.
Okay, so it's a way to fix putting money in the wrong type of IRA for your situation.
Exactly. But there's one huge change the IRS made that you absolutely have to know about.
What's that?
Starting in 2018, you cannot recharacterize a Roth conversion.
Wait, what's a conversion versus a contribution?
A contribution is new money you put in for the year, up to the annual limit. A conversion is when you take money that's already in a pre-tax account, like a traditional IRA or a 401k, and move it into a Roth IRA. You typically pay income tax on the converted amount in the year you do the conversion.
Okay, so moving existing pre-tax money to Roth.
Right. Before 2018, if you did a Roth conversion, and then maybe your income spiked that year, making the tax bill painful, or the market dropped right after you converted, you could recharacterize it, basically undo the conversion, and put the money back into the traditional IRA.
And you can't do that anymore?
Nope. That ability to recharacterize conversions was eliminated by tax reform for conversions done in 2018 or later. Once you convert pre-tax funds to a Roth IRA now, that decision is generally locked in. No takebacks.
Wow, that is a massive change. You really need to be sure before you do a Roth conversion now.
Absolutely critical point. You can still recharacterize regular annual contributions between traditional and Roth, subject to the rules, but conversions, that door is closed.
Okay. Whew. We have covered an incredible amount of detail on the core IRS rules, prohibited transactions, who's disqualified, how to fund these things, the super complex tax rules on contributions, deductions, limits, how to fix mistakes.
Yeah, it's a lot to absorb.
But investing in real estate, especially through an SDIRA, isn't just about tax rules, is it? The sources pointed out some other really practical risks and considerations.
Definitely. Once you get past the IRS compliance maze, the nature of real estate itself brings its own challenges within an IRA. The entrust source really highlighted liquidity risk.
Meaning it's hard to turn into cash quickly.
Exactly. Stocks, bonds, mutual funds, you can usually sell those pretty fast, get your cash in a few days. Real estate, not so much.
Right.
If you need money from your SDIRA, maybe for an emergency, or even just because you've hit retirement age and need to start taking required minimum distributions, RMDs, from a traditional IRA, well, selling a property takes time.
Months, potentially.
Easily. Finding a buyer, negotiating, going through inspections, appraisals, financing approvals, closing, it's a process. So you have to be okay with the idea that a significant chunk of your retirement savings might be tied up and inaccessible on short notice.
That's a huge planning consideration. Your retirement funds aren't liquid anymore.
Precisely. And that ties right back into the due diligence point we started with. Entrust emphasizes again, it's all on you.
Because it's not like a stock with public filings.
Right. Alternative assets like a specific rental property don't have standardized quarterly reports. You have to do the legwork, checking the market, physically inspecting the place, researching title history, understanding local landlord laws, getting repair quotes, figuring out a fair price.
Right.
It's way more involved than researching a typical stock or fund.
So you really need to be prepared to act like a professional property investor, even though it's inside your IRA.
You absolutely do. The risk is much higher if your homework isn't thorough. Another thing hinted at in the entrust materials, potential tax bombs, really, are concepts called UBIT and UDF.
UBIT and UDFI. I thought IRA income was tax sheltered.
Generally, yes. But there are exceptions. UBIT stands for Unrelated Business Income Tax. If your IRA engages in an active trade or business that's not related to its core purpose of passive investing.
Like what? Flipping houses, maybe.
That's a potential example. Just holding a rental property passively usually doesn't trigger UBR. But if IRA is actively developing land or running a business out of the property, some of that income could become taxable to the IRA itself at corporate tax rates.
Wow, okay. What's UDFI?
That's unrelated debt-financed income. This one is particularly relevant for real estate. If your SDIRA uses debt, like takes out a mortgage to buy or improve the property.
Which seems common for real estate.
Right. But if the IRA borrows money, it has to be a non-recourse loan, meaning only the property is collateral, not you personally. Then a portion of the income generated by that property, both rental income and potential capital gains when sold, can be considered debt-financed income. And that portion is subject to UBI.
So using leverage, using a mortgage inside the SDRA, could actually make some of the rental income and profit taxable within the IRA.
Correct. It's not automatically tax-free just because it's in the IRA if there's debt involved. The calculation is complex based on the ratio of debt to equity, but the bottom line is leverage can trigger taxes inside your retirement account.
That completely changes the math. That's a huge potential surprise.
It is, and it's complex enough that you almost certainly need professional tax advice specializing in SDIRAs and UBIT before you even think about using debt financing for real estate in your IRA.
Good warning. Anything else on the practical side?
Just one more mention in the entrust source menu, the need for fair market valuation. Because real estate is illiquid and doesn't have a daily ticker price.
Right.
You're required to get periodic valuations to establish the property's fair market value. The custodian needs this for annual IRS reporting of the IRA's total value. And it's absolutely critical when you hit RMD age, because your required distribution is calculated based on the account's value.
So I need to pay for appraisals regularly.
Typically, yes. You'll need to hire a qualified appraiser periodically, and that cost has to be paid from the SDIRA funds, not your personal funds. It's another ongoing expense of holding real estate in an SDIRA.
Okay, let's try and wrap this up. We've covered a massive amount of ground here, diving deep into using SDIRAs for real estate based on these sources.
We really have. We started with the basic idea. SDIRAs open up investment options like real estate, but that self-directed part means you are responsible for the due diligence.
Then we hit the absolute core, the IRS rulebook. Avoiding those prohibited transactions is paramount. No self-dealing, absolutely no personal use, no doing your own repairs. We define disqualified persons, spouse, kids, parents, grandkids, their spouses.
Right. And we talked about the mechanics. Money flows directly in and out of the SDIRA only. Property title must be in the custodian's name, FBO, your IRA.
Then we went through funding. annual contributions, the rules around compensation, and rollovers, emphasizing direct rollovers to avoid withholding and clarifying that tricky one-year rule.
And the really dense part, the tax rules. Traditional IRA deductibility based on income and workplace plan coverage, Roth contribution limits based purely on income, the painful 6% annual penalty for excess contributions and how to fix them timely or apply them later.
Plus, the 10% early withdrawal penalty generally and recharacterizations, understanding you, can still recharacterize contributions, but critically. Not Roth conversions anymore since 2018.
And finally, we step back from the pure tax rules to look at the practical realities. Real estate is illiquid, demanding intense due diligence from you, the potential tax traps of UBIT and UDFI, especially if you use debt, and the ongoing need and cost for fair market valuations.
Yeah, the sources make it incredibly clear. Using an SDIRA for real estate can offer potential benefits, sure, but it demands almost obsessive attention to detail, a deep understanding of complex rules, and a realistic view of the risks. It's definitely not passive.
Not passive at all. From a compliance and management standpoint, it's a serious commitment.
Absolutely. And, thinking about all these rules, the restrictions, the reporting, the potential tax pitfalls like UBIT, it really makes you reconsider what self-directed means in this context. It's not just about picking an asset. It's about becoming, effectively, the active trustee and meticulous manager of that asset within a very regulated retirement structure. Given all that complexity, especially with something as hands-on as real estate, you really have to ask yourself, am I truly prepared for that level of responsibility? That's definitely something to chew on long after this deep dive ends.